and welcome to Investors Hangout. This fortnightly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, every new year brings with it a series of resolutions and promises that we make. Investors do the same. There are, a set of things that they want to do in a new year. There are certain things that they want to avoid doing. So now in 2022, if you are one of those investors trying hard to identify the best investment opportunity to make some money, or even if you want to be cautious, we have with us our CEO, Dhirendra Kumar, to help you with that. Welcome, Dhirendra.
Thank you.
Now, 2021 has been a blockbuster year of, for technology specific funds. So what's your view on them? Should one invest in technology funds in 2022 as well?
One is that most investors can do without investing in any sector fund because technology is a very prominent sector. If you invest in a diversified fund, it will have sizable allocation to technology as well. As far as any sector fund or any thematic fund is concerned, when you look at the outliers, it is always, whether it be the funds at the bottom or funds at the top, they always tend to be something which is exotic, a sector fund or a thematic fund, something which is very narrow. And that is what was there in 2021, which was technology. The year before that was pharma. The year before that would have been something else. I remember 5 years back, it was technology once again. But I think most important thing is that what is going to be consistently performing well over the period of your investment, next couple of years, your investment time frame, which we keep insisting that it should be many, many years for equity. So I think, technology is one sector which has belied, which has defied one of our assumption that the year in which technology doesn't do well, then it is not at the subsequent year, it is not at the bottom. It is always, either in the middle of the road or at the top or whatever. Being at the top is a matter of, relative performance, how others have done. But technology looks promising. But it should not be a sizable part of your allocation. You should have some if you want to tilt towards technology. But most investors can do without it because most of your diversified fund will have 15, 20, 25% into technology.
All right. So diversify your investment and not so much in technology. Even if you want to, then a little portion you can. That's what you're saying. Okay. Then what about the hybrid category of funds? I've heard many people recently investing in hybrid funds with dynamic asset allocation. Do you recommend them to withstand market volatility in 2022?
Undoubtedly, with the very design that they are not all equity, they have a meaningful allocation to fixed income. That itself will provide the resiliency. That itself will provide the greater stability. It will not crumble if the market, falls freely. But I would say that, not in this market. In fact, right now, a lot of people are getting into the market. They are willing to start their investment, but at the same time, they are apprehensive, and understandably so, because of all the reasons that variety of reasons, the market has continued going up despite all the apprehensions on the economy. So people are reluctantly putting their money, and I think that is a good strategy because most investors, when they start chasing performance, assuming that investors have choice, if they're chasing performance, they tend to invest. They might be investing in technology or some such thing. As compared to that, the balanced fund, the balanced advantage fund, the dynamic allocation fund, they turn out to be they prove to be more stable. They will not scare an investor and drive them out of the market forever. And because this story is striking a chord with investors, that one should be little apprehensive about of the market. That is perhaps the reason why investors are buying into it as well.
Okay, and where should one invest in 2022? Specifically with Omicron cases peaking now and the fear of the next wave hitting us. Any particular sector or trend that you foresee outperforming?
Uh, even at the cost of being sounding repetitive, being stuck, sounding like a stuck record, I would say that keep it diversified, invest your long term money, and be regular with your investment. Uh, it is very hard to guess which one will do well. And most investors, if you are thinking in terms of 2022, it's not that you will invest in January and you will take your investment out, in December 2022. So that should not be the time frame of your equity investment. So with that in mind, I think it is a futile exercise to be guessing what will be the most promising thing, because if one gets into the most promising thing, then it is important to be finding the next promising thing after the promise has been met. And that could be after 3 months, that could be after 6 months, and that is not the business here. It is extremely difficult to get the market in the short run. So that is why I will, warn investors that be beware of this. Don't try to guess it, and don't formulate your strategy based on that. Be at the cost of sounding like a stuck record, I would say that be choose one or two good funds. If you are a first time investor, choose a balanced advantage fund or a balanced fund. If you are a mature investor, if you have seen the ups and downs and you are not getting scared, maybe 20% of your money can well be into small cap, can be into mid cap, but not more than that. Don't forget the basic rule that you have to diversify. It put your long term money into equity and be regular with it. Even when you see the market crumbling, that is the time when you should not pull out, and that is the time when you should not stop your investment. And that is what drives that is what actually contributes to your long term performance.
All right. So the mantra more and less remains that you invest consistently. Don't look
Yeah.
for short-term gains. Investing in equity. Look for long-term investment period and diversify well. Time now to move on to our viewers' questions. Sunil Badami has sent in the first question. He wants to know your opinion about the newly launched silver ETFs. Is it a good idea to invest in them?
uh, it is a new vehicle which has become possible, has been enabled for Indian investors. So far, Indian investors could have invested only in the gold ETFs. Now, the silver has been enabled. By its design, it has made it easy for investors to invest in silver. But I think most investors can do without it. I don't see a reason why one should be investing in it. I don't understand the investment case. There could be an investment case for some people who understand it, and it will amount to this. This is like investing in a commodity, and commodity prices, including gold, including silver, are cyclical. So if you are able to, so you have to bet on the cycle. That is it at the low, and will you be able to exit at the high, and or close to high, and is it close to low? Because finding the perfect low and finding the perfect high is impossible. So if you have any kind of inkling in terms of doing this, or to be able to do this with a approximate ability to time the cycle, then do it. Otherwise, don't. Most investors can do without investing in just because there's a novelty, it has been made available, that doesn't mean you have to invest in that.
Sujit Pathak asks, what is the outlook for debt funds in 2022? Which are the safest categories as interest rates are likely to rise? Should one consider hybrid funds as an alternative?
uh, yes, short-term debt funds will turn out to be most resilient, uh, simply because they are not taking the interest rate risk, they are not taking the maturity risk. And make sure that you are not getting into, we still are not through with the worst time for the credit. So I would still urge investors to get into relatively safer debt fund, which means, look, even if you are investing in a fund which is into corporate debt, make sure that they are into highly rated ones, and definitely completely out of the questionable ones or the lower rated. And you can get all this information on value research online in the portfolio section of each and every debt fund. And short-term funds will turn out to be the most resilient. Now, which other kind? Uh, I think the funds which one should be wary of are the long maturity funds, because looks like interest rates might go up, and if interest rates go up, uh, long maturity bonds go down in value, and quite dramatically. Many a times investors think that they are investing in a gilt fund, and it is safe. Yes, it is safe on one dimension, but it is not safe on the other dimension, and in fact they turn out to be more vulnerable, because government securities or many gilts, they are very long maturity, 15-year, 20-year. And if a fund has any of those bonds, then they actually sometimes the decline looks like as if it's an equity fund. We see a massive blow up there. So be careful about that. And generally speaking, for shorter maturity bond fund, it can also be good news because the current yield will go up as well.
Suraj B. Singh wants to know what are the prospects of infrastructure specific mutual funds for the next 5 to 7 years?
I would urge most investors to keep away from infrastructure funds. Just don't like them for one reason, that the definition of infrastructure is very loose. Any fund can be an infrastructure fund if it is not investing in technology and pharma. And that is how, because they have kept their definition very loose. So they don't deliver anything substantial, and they deprive you of, they actually constrain you, or they are constrained by this by calling themselves infrastructure funds. And we have seen, there was a boom in infrastructure funds. These funds did well. The underlying companies did well. And that was, 10, maybe about 13 years back. The good times of infrastructure fund was over by 2008. And ever since we have been waiting for that turnaround, and it has not happened. In between, we see that, they do spurts, but keep off these funds. They have proved to be extremely disappointing over a very long period of time, and they are unnecessary constraint.
All right, then, Suraj, you might as well avoid infrastructure funds. Now, Krish has sent in the next question. He's a do it yourself kind of investor, he says, and he's been investing in mutual funds through SIP for many years now. He has a home loan at an interest rate of 6.9% with an outstanding tenure of 4.5 years, and its monthly EMI amounts to 20,000 rupees, he says. Also, he's expecting a lump sum amount as gratuity proceeds. So, should he utilize it for clearing his home loan or invest it somewhere else?
My general advice is that, if you have a home loan is the only loan which is good to have. All other loans are avoidable, or you should be prepaid before you start investment. But alongside investment, this is the only loan you should carry for a variety of reasons. One is that you save on rent. You also get little tax break because you're on the interest that is paid on the home loan. And the interest on home loan, a very long maturity home loan, is is low, and the long term returns on your investment is tend to be much higher than, the low interest that you incur. So it turns out to be a profitable deal, that you are investing, your investment will be yielding more return, and your interest cost will be lower. So it's a nice arbitrage. So that is the only. But in his case, if he's getting gratuity and if he's little apprehensive about uh, his future income, and he will derive great comfort by not by being completely debt free, then by all means he should prepay. Otherwise, and if he's sure about his income prospects and the future income is not uncertain, then there's no problem in carrying on with this home loan. But little apprehension, deriving comfort, the pleasure of being completely debt free, then might as well prepay.
Rajendran Nagarajan wants to know if gold would be a better option than a short duration fund due to the rising inflation, and how is the metal likely to react?
Yes, that is the theory, that gold should prove to be a much more stable and rewarding thing when you have the interest rates go up and uncertainty. This turns out to be a safe haven. But that is the theory. The real situation is that gold has proven to be very volatile, and variety of reasons contribute to its volatility. The demand supply situation changing, uh, the central bankers buying and changing taxation rules. Many a times, different countries do clamp in, including India, where we have the now customs duty on import. And last year, we have been a sizable importer of gold. In fact, gold has, I think, turned out to be the largest item of import in India. So that is quite scary. That's very disappointing for the government. when the government is working hard to financialize and actually free the assets. Government dislike gold as an investment simply because it is a relatively unproductive asset. When we buy bond, it goes into productive assets. When we buy shares, when we buy equity mutual funds, the money is buying equity, but ownership, which actually the factories, the industries, the services. But when you buy gold, you actually buy it and keep it in the locker, and it stops working. So in that sense, governments discourage. But I won't be surprised. The current context contributes far more heavily to the volatility of gold. I would say keep it simple. Be into short-term and ultra short-term debt fund. That's a way to navigate the likelihood of rising interest rates.
Mohit Savalia asks, would you suggest moving money from a debt fund to an arbitrage fund in the current interest rate scenario? The holding period is 1 to 2 years, he says.
Uh, yes, but it will not translate into something very meaningful because arbitrage funds are also yielding little, sometimes little more, sometimes little less, but the returns are anchored almost around a liquid fund. The only advantage is that if your investment is less than 3 years, the tax treatment will be, you have to pay only 10% because the arbitrage funds are treated as equity funds from a taxation point of view, which is 10% on the gains that you will pay if you hold it for 1 year and redeem it, realize your investment gains before 2 years, uh, which is still better there because if you invest in a debt fund, all your gains will be treated as income and taxed at your marginal rate. So arbitrage funds will actually prove to be more tax efficient.
All right. Sanjay, a government servant, is about to retire and has experience of 15 years of investing in the market. Out of the retirement benefits that he will receive, he wants to earmark 35% for the marriage of his daughter, which is likely to take place in the next 2 to 3 years. So, where should he invest this money? Also, he wants your suggestion on investing the remaining money. The pension is likely to be sufficient for his monthly expenses.
First, the 35% for his daughter's wedding. I think look at a short-term debt fund and divide it in two, three funds equally, so that you're not dependent on one fund, definitely doing well. At the same time, choose the funds based on their credit rating, high allocation to AAA and government bonds. Don't And when choosing a debt fund, this is something which every investor should take note of. When investing a debt fund, make sure that you are not investing in the best funds of its category, because the best funds tend to be they normally tend to assume some risk, and which may not have the shown its the dark face. So you have to make sure that you're avoiding the best performers, and in terms of return, that is how you can actually avoid the risk and look for the relatively more conservative, the funds which have higher allocation to AAA and government bonds. And remaining money, because he is experienced, he has been investing for 15 years, choose one or two, flexi cap, multi cap funds and be there. Because you are not going to depend on this investment for your income, and you would like to maximize your return from these investments, it should be into equity. You are very lucky to have the safety net of a pension, which will not only be if you it'll also be adjusted in line with the inflation. It'll keep getting revised upward. So a very fortunate situation. Make the most out of it by maximizing your return of your superannuation accumulation.
74-year-old Arun Sardish Pandey has sent in the next question. One of his fixed deposits worth 25 lakh rupees is maturing shortly. So, where should he invest the amount considering that the interest rates may increase soon? He's already fully invested in government schemes like the Senior Citizen Savings Scheme, Pradhan Mantri Vaya Vandana Yojana, and Post Office Monthly Income Scheme.
I'm quite tempted to suggest him to invest in equity savings scheme, but they tend to be little volatile, unlike fixed deposit, but they're not as volatile as equity. These are funds which invest 10, 15, 20% into equity and remaining in fixed income. Uh, looks like, if you are doing your fixed deposit, which means that this money is lying there, you might as well optimize your return. So that is one relatively riskier way of, but I think, if you look at it from a fixed deposit time frame, 5 years, 3 years, I don't think it is risky. In the short run, it might look risky. Uh, so that is one path. The other is invest in a short-term debt fund. You will get your return almost like your fixed deposit. You will have greater liquidity. So just in case you need the money sometime in between, you will have that. And the other investment that you have made, except for the post office MIS, which will be giving you some monthly income, all other are not, senior citizen savings scheme will give you a quarterly income. So in that sense, you are deriving your income from here. This money, it should ideally have you be invested in equity so that, it contributes to protecting the worth of your capital. Because if you invest all your money into fixed income, it will not preserve. If you consume the income, it will not preserve the value. So the first option is still desirable, but if you want to have a risk, very low risk or modest risk option, consider short-term debt funds.
Kapil asks, what is the best way to look at undervalued stocks?
To spot a company, to spot a stock which is undervalued, you have to value a stock, and the stock valuation is a combination of art and science. Uh, the scientific bit is that you can apply some kind of discounting formula that you are willing to pay this much money for a stock for its 5 years, 10 years potential earnings, and you can have your own estimates of rise or decline, and there could be variety of factors, and the art part of the of selection or your judgment is that you will have to think about how good is the management. Will they steal money from the company, or are they credible enough? The other part is the sector promising enough, and will this company be able to capitalize on all the opportunities? Is it a scalable business? So that is the subjectivity bit, your imagination, in terms of, and the likelihood of that proving to be true. So this is one part, and this is a simple part of the story. The other part is that to find an undervalued company, you have to look for a company where you are extremely positive about it. You are very optimistic about it, but the whole market is uh, not so optimistic or pessimistic or hold negative opinion for variety of reasons. So one is that you have to do this. Find a company where you are positive, you are optimistic, and others are not. And then to make money, you have to be right, and others have to be wrong. So this is the risky bit.
Ramesh D. Patel has sent in today's last question. He asks, would you suggest decreasing the SIP amount in an overvalued market and increasing it in an undervalued market?
No, it amounts to timing it, and nobody can do it perfectly. And also, particularly this strategy will not work because it entirely depends. Most of your accumulation has already happened. If you have been doing SIP for 5 years, 10 years, then imagine that you are doing a SIP of 10,000 rupees, but you have been investing 10,000 rupees for 5, 7 years or 10 years. Imagine 10,000 rupee being invested for last 10 years would have the principal contribution will be 1 lakh 20, so it will be about 12 lakh rupees, and possible that this will be worth about 50 lakh rupees, or 35, 40 lakh rupees. That is the kind of potential growth that would have happened in the last 10 years. And uh, in an equity fund, possible in an equity fund, and you are trying to time it perfectly and thinking that something significant is going to happen with 10,000 rupees. Because if the market is going to come down, if it comes down by 10%, and instead of investing, stopping your SIP of 10,000 rupees, your 50 lakh rupees will come down by 10%, which will be a 5 lakh rupees hit on the market. So don't do all this. I think the whole joy of SIP is that you have the discipline, and it turns out to be right most of the time. And uh, follow your needs, be guided by your needs, and be a little more conservative. Take your money out, the amount of money which you need in next 2 3 years. Be a little more conservative. But all these things really don't work, and that can also distract you. And the other disadvantage is that if you turn out to be right, you will be thinking that some magic will happen. But the magic happens only when your money remain invested and the market does well.
Well, with that, it's a wrap on this episode. Thank you, Dhirendra.
Thank you.
Thank you to all our viewers. Do keep sending us your questions and watch this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.